Most people start with the stock price. I start with the business. In this video, I'll show 5 questions I use to understand any stock before I spend my money on that. You do not need a finance degree, you only need a clear process. Let us use Apple as a simple example because most people already understand that company. Apple sells iPhone, Macs, iPad, and services, but knowing the product is not enough. We need to understand how the company makes money, whether that money is growing, and how much investors are paying for that. So, starting with step 1 is to understand how the business makes money. Try to explain in simple 1 or 2 sentences. If you are able to, then you would be able to understand that business. So, Apple earns most of its revenue by selling devices. And it also earns revenue from services, the App Store, iCloud, Apple Music, advertising, and warranties. That simple explanation already tells us that Apple has 2 important parts, products and services. So step 2 is to check whether the business is growing or not. Look at revenue over the last 3 to 5 years. One strong year does not define that. You want to understand the direction of that business. Is revenue increasing because of the company is selling more products or charging higher prices? If revenue is growing but profit is not, ask where that money is going. Step 3 is to check the financial health. I mainly look at margins, cash flow, cash debt. Margin shows how much financial pressure the company may face when business condition becomes difficult. Debt is not automatically bad, but it should be manageable compared with the company's cash flow. Step 4 is valuation. A good company can still be a poor investment when price already assumes perfect results. A basic starting point is to look at PE ratio, which tells us how much investors are paying for each dollar of earnings. Compare it with and similar companies. A high PE is not automatically bad, but it means expectations are higher. And step 5 is risk. Every company has risk. For example, even Apple, that it is mainly depend on iPhone. Our competition or even regulations of Apple Store. Supply chain could be an issue and in different countries, for example, China. So the goal is not to find a company with no risk. That company does not exist. The goal is to know the main risk before it appears in any headline. You already understand the company better than someone who is looking only at the stock chart. Doing this manually means opening annual reports, earning releases, and several financial websites. That is one reason I built the stocks school. I can search, for example, Apple and see the business overview, revenue trend, margins, cash flow, debt, valuation, and major risks in one place. The website does not make the decision for you, it organizes all this information. Now, if you put all these 5 questions together, how the company makes money, is the business growing, is it financially healthy, is the valuation reasonable, and what could go wrong? If you can answer those 5 questions clearly in a very simple terms, so you can ask a better questions and do your own research. That is the complete first check. Understand the business, growth, financial health, valuation, and risk. Try it with one company you already know and see if you can understand that business. In the next video, I will use same process to study Nvidia and separate the business facts from the market excitements.